Okay, let's go ahead and get started. I'm Nick Johnson. This is our quarter 3 stock market update. It's been a bit of a wild ride this year. With Trump coming into his second term, there's been a lot of policy changes, April Liberation Day. But despite all of the uncertainty, the market just continues to run. We're going to dive down into what's happening, how people feel, what to expect, and what we even want to be thinking about from the One Big Beautiful Bill Act. But before we do, a little bit about myself as well as the firm. I'm Nick Johnson, President and Chief Investment Officer at Willis Johnson Associates. I've been working with corporate executives and professionals for over 15 years, helping them with their financial plans and guiding them through good and bad markets. If you have questions, list them in the follow-up survey at the end of the webinar. We'll get you a detailed answer. And do follow us on LinkedIn, Facebook, YouTube. We're regularly posting educational content to keep you informed of what you need to know. Okay, Vibecession. So what is a Vibecession? Now, when I really brought this up, because this is a term that is being thrown around a lot from market strategists, my team was like, wait, Vibecession, is that good? Is that bad? Vibecession is a combination of the words vibes and recession. And the idea behind a Vibecession is people don't feel great about the economy right now, but in reality, things seem to be going pretty good, all considering. So how people feel, the soft data, and what's actually happening, the hard data, are at quite a divergence. And I think that's been impacting the markets a lot. So one of the biggest things that is often talked about is consumer sentiment. And that's what I'm posting for you right here. Consumer sentiment in June has ticked up a bit, but in May, we hit a low that we saw when inflation was over 9% in 2022. We saw consumer sentiment at a low similar to the 2008 recession or the 1999 tech bubble. So people have been feeling in kind of April, May, similar to how they normally would during a recession, when frankly, things seem to be pretty good. Now, if we ask why, what's really going on here? One of the things people are concerned about is inflation, right? Inflation was scary high in 21, 22. Seems like we just got our arms around it, and everything the media is telling us is that, oh my gosh, we're going to get crazy inflation. And if we look on the left, we can see consumer expectations of inflation 5 years out. So if you survey people and you ask them, what do you think inflation is going to be 5 years out? Consumers, your average everyday people, think inflation is going to be trending towards 4.5%. Now, professionals think inflation might be a little bit higher, 2.5%, but overall, people feel like inflation is going to be trending towards 4.5%, so significantly higher than where we're at today. One of the other challenges that I think is contributing to that sense that things aren't that great is this right here. The gold is the growth rate in the US median family income. The green is the growth rate in the price of a single family home. And I'm only showing you the last 10 years, but this trend in the first half of the chart has been pretty much the trend for a while, that homes and incomes are growing together. Then all of a sudden, COVID happened. We had all this massive government stimulus. We brought interest rates down to 0. And all of a sudden, home prices shot up. People also wanted bigger homes and nicer homes because they're working from home more frequently. Well, the growth rate and the price of a home shot up, but incomes really haven't. And this is a challenge. Home affordability is hard right now. We have a lot of interns. We have a lot of our interns that turn into full-time employees, and especially when I have full-time employees here that 2, 3, 4, 5 years, that's usually when they start saying, okay, I want to buy a home. But the unaffordability of a home is challenging. And this is even before we get into impact of mortgage rates, impact of property taxes, impact of insurance costs, all have been rising dramatically. So part of what people would normally expect is, this is what I do at this stage in life. It's more challenging reach today than it has been in a while. One of the other big fears we're hearing a lot about is public debt. Right now I'm looking at total public debt as a percent of GDP. This includes entitlements like Social Security and Medicare. Total public debt is over 120% of GDP. And you can see how it's really been shooting up during COVID, how it shot up past 2007 and the mortgage crisis. So our total public debt is massive. And the fear is this going to cause a recession? A drag on the economy? What's going to happen? Additionally, one group of people that rate things particularly rough right now is new grads. Traditionally, if you have a college degree, your unemployment is lower than average, and that's not what we're seeing. We're seeing higher unemployment for recent college graduates than we're seeing on average, and that's unusual. And there's a lot of fear going on that how are things changing the market? Is this AI? Is this something else? What are we exporting jobs to India? So there's a lot of fear going on about what this means for careers and what this means for potential. The other thing that we're all seeing every day is headlines. Trump seems to like to make headlines. And whether you agree that Trump is doing a fabulous job renegotiating US trade, or whether you see this as a horrible thing and that free trade that we're getting away from is where we need to be at, you can't argue that this creates some level of uncertainty. I was just speaking with a client of mine yesterday, and he's a professor at a major university, and he was telling me, I don't know when we should be buying things. There's a whole bunch of equipment that we want to purchase from Europe, and do I buy it now? Do I wait? Do they get a trade deal? Do we do it next year? And these are seven-figure purchases. And the dilemma is that uncertainty makes it hard to make decisions, whether you're a business owner, whether you're an individual, and just people that are making purchasing decisions. Because we have such a globally interconnected economy, this creates uncertainty, and that adds to the fear. And we can see the volatility in tariff policy right here. Depending what date we look at it, tariffs have moved around a lot. And we just don't know where we're going to end up, which makes it hard to plan. The last thing I want to emphasize is you likely feel dramatically different about your expectations of the economy based on your political affiliation. So this is a University of Michigan survey. So same first survey we looked at, but it breaks down by political affiliation, and it asks a different question. Not how are things today, but what are your expectations of the future? So this is consumer expectations of the economy. Well, if you're a Republican, you actually feel like things are pretty good right now. But if you're a Democrat, you feel worse about your expectations of the economy than we did in the 2022 inflation spike, than we did in 2008, than we did like in any period of time. Democrats have never felt worse. Independents feel that expectations of the economy similar to where they did in 2022 and similar to how they did in 2008 recession. They feel like this is recessionary times. And when we start looking at the data, things just aren't that bad. For one, since January, maybe even since Trump got elected, the media across the board is saying inflation, 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 tariffs cause inflation. Yet we look at inflation rates from June of 2022 of 9.1%, and they've come down dramatically. Now, there is a recent tick up that we have seen in headline inflation from about 2.5 to 2.7, but that's mostly driven by energy, a little bit of core goods, which may be inflationary. But we're not seeing massive inflation due to tariffs, at least not yet. Of course, it's still early. Things are still getting negotiated, and we'll see what the future holds. Part of what inflation is causing, or the fear of inflation, even the Fed, even professionals are worried that tariffs could be driving inflation up. And it may over the next 6 to 12 months. Well, one of the things the Fed has said is that we got to wait and see. We want to nip inflation in the bud. The Fed is cautious to lower rates. And honestly, I think there's some justification to this. Right now, the federal funds rate is between 4.25% and 4.5%. If we look at the expectations, what the market believes the Fed is going to do, and this is a betting market, people are investing based on expectations. The market believes there's a 7% chance we get no rate cuts this year through the end of the year, through December. The market thinks there's about a 30% chance we get one and about a 40% chance we get 2 rate cuts. So overall, we may get something, but there's not a big likelihood we're going to get a lot of rate cuts. And part of it is the Fed's got a 2-part mandate: inflation and unemployment. And unemployment is crazy low. We're at 4.1% unemployment today. The long-term average is 5.5%. The Fed has even said a healthy level of unemployment is between 4 and 5. And frankly, these are great numbers, right? Pretty much anyone who wants to find a job can find a job. Maybe not their ideal job, but they can get one. Now, one of the few things that is a little bit concerning, I want to draw attention to, and this is a leading indicator of unemployment, is continued claims for unemployment insurance. This has ticked up in 2025. So these are people that are going on unemployment and staying on unemployment, not able to find a job, and it has been ticking up. It is a leading indicator. If it continues to get worse, then we would be concerned about the unemployment number potentially going up in the future. So these are some of the things the Fed and ourselves are watching. But overall, when we look at the job situation, things are pretty good. So if we look at the left graph, this is job openings. Today, there's over 7 million job openings. And compared to the grand scheme of things, if we go all the way back to the 70s, this is great. This is phenomenal job openings. But the reason people don't feel good is we compare where we're at today, not to the long-term perspective, but to our recent memory. And just in 2022, we had over 12 million job openings. It was easy to find a job. People were quitting jobs and had nothing planned and had no fears and no concerns and immediately found something that was generally higher paid. Well, that was unusual. Things are actually good compared to long-term right now, but they don't feel as good as to where things were just a couple years ago. And if we look at the non-farm payroll gains, despite all the layoffs in the government, despite all the uncertainty with businesses, payroll gains have been positive. So this is people getting jobs versus losing jobs every month. That's the blue line. That's what we're looking at. What do you notice? Well, overall, they're decelerating, right? The blue line is smaller as we go further to the right. So we're decelerating, but it's positive every single month, which means net, more jobs are being added to the economy than job losses every single month. This is a very healthy place to be. If it starts going negative, then we start getting concerned. Now, one of the few data points that I would say is negative was first quarter GDP. First quarter GDP was down 0.5%. And traditionally, a rule of thumb about a recession is 2 consecutive quarters of negative GDP. But we have to go look at the data and say, okay, what really happened? And you can see the purple right there on the far right. The purple really brought GDP to be negative, and that is net exports. What actually happened? Everyone knew we were going to have tariffs in April. Not everyone expected them to be as big as Trump announced, but we all knew that Trump said he was going to do tariffs in April. So you know what businesses did? You know what consumers did? We bought stuff early. We bought cars early. We imported goods internationally early. We did all of this stuff in December and January and February. Purchases we may have made in the summer or in the fall, we brought forward. And by doing that, that hurts GDP because when we buy internationally more things, that's a detractor from GDP. The problem is, if we brought all these things forward, we might not actually be buying as much internationally over the next couple quarters. And that's really what we're seeing. If we look at this is the Atlanta Fed's GDP Now estimate. So this is the Federal Reserve from the Atlanta office. They do the green, the GDP Now estimate. What do they think GDP is going to be for the second quarter? And they're telling us GDP is on track for 2.5%, which is a very healthy number. Matter of fact, the blue chip consensus, the Goldman Sachs, the Wells Fargos, the JP Morgans of the world, they think GDP is going to be about 2%. So overall, it looks like we might just have had a 1-quarter blip because people were doing the rational thing, buying stuff early before tariffs go into effect, which means they're probably going to buy less in the second or third quarter. And if we look at the market, as I mentioned earlier, everything is positive year to date. Internationals are up over 20%. Emerging markets are up 19%, and the S&P 500 is up 9%. Things are great. Now, one of the concerns I'm starting to hear from our clients is, oh my gosh, the market's run a lot. There's still a lot of uncertainty. We still don't feel good about things. What should I do? I had a client this morning that said, hey, Nick, I just received a payout from my non-qualified plan. It paid out. It's going to cash. I worry, is now the right time to invest it after the run we've seen with everything going on in the world? And so this is a normal fear that we're starting to get is, should I stay in cash or is now the time to get more conservative? I want to walk through this. We're hitting all-time highs in the market, right? I think we're at maybe 12 all-time highs now through this point in July. And it's scary when there's all this uncertainty going on, yet we're hitting all-time highs. Do I keep investing? Well, if you have a time horizon that's 5 years or more for that money, if we don't need the money for 5 years or more, yes, you should be investing. Even if it's at an all-time high. Let's look at the data. So if we go to the far right chart, we can see here the green investing at all-time highs. And we can see investing at all-time highs at a 5-year gives us over 80% return compared to 74% investing on any other day. Same thing with 3-year. We're better off investing at all-time high than any other day. Same thing with 2 years, same thing with 1 year. And past performance is not a guarantee of the future, but oh my gosh, the vast majority of the time, when you invest in an all-time high, you actually outperform, oddly enough. But here's another really crazy, really strange conceptual thing. The same client was saying, Nick, what about if I wait until we get a pullback or recession? Because we're going to get a pullback or recession. My answer is yes, we're going to. What if I wait till we get a pullback and recession and invest then? Well, here's the thing. Yes, we're eventually going to get a pullback or recession, but we may have missed an opportunity. If we look at the left, every green dot is a point in the market that's an all-time high that's also a floor. So why is this important? Over the long run, the market goes up and to the right. Well, oddly enough, let's say today is an all-time high in the market. It's possible that today an all-time high in the market is also a floor, which means the market never goes beneath today's price again. Matter of fact, 30% of the time, all-time highs actually are also market floors. So that means if you decide to hold cash or dollar cost average or don't get your money to work, 30% of the time, you never get a better price than today, even when the market's at an all-time high. And partially that's some of the behavioral elements, like we're emotional investors, right? People have FOMO, the market's up, they feel like they're missing out. New highs tend to happen in clusters, right? There's a little bit of momentum, and that's been proven in terms of the market. New highs tend to happen in clusters, so when things are running, it tends to continue running. And if we look at some historical data, and this was put together by Charlie Bellio, a strategist I follow, we just had a phenomenal 13-week run in the S&P 500, right? One of the best. I think this is the 8th best 13-week run we've seen. If we go from Liberation Day, April 4th, to the 4th of July, the S&P was up 24%. Well, if we look at other time periods where we had phenomenal run over 13 weeks, how did the market do after that? Well, on average, 6 months after that, the market was up 11%, as opposed to 5.7% all other 6-month periods. On average, after a big 13-week run, the S&P was up 22% for the next year versus 11% all other periods. So actually, times like this are really good to be an investor historically. No promises that's necessarily what we see again, but don't be afraid to stick with your long-term plan, even if the market has run recently. Let's dive into some of the details. The other thing that happened on the 4th of July is Trump signed the OBBBA, the One Big Beautiful Bill Act. So I'm going to be doing a webinar in late August talking about tax planning and optimization for the OBBBA, because there's a lot of changes, there's some complications, there's some weird phase outs, and we want to make sure you understand it and can take advantage of it. Our advisors are up to date and they're already helping our clients with tax planning today. But for the purposes of this market update, overall, there's a lot of benefits people got on taxes. The standard deduction went up. If you're over 65, you got a bonus standard deduction. This is in replace of no tax on Social Security. We got higher SALT deductions up to $40,000. We got a higher child tax credit. The estate and gift tax went up to $30 million for a couple. And Trump added in his no tax on tips, no tax on overtime, as well as the auto loans in certain situations, the interest is now deductible. So all of this generally means it could be adding to the deficit. And matter of fact, that's what the CBO, the Congressional Budget Office, believes, is that we're adding to the deficit by this bill. The Republicans and the Trump administration would argue this is going to increase the growth rate, and we're cutting other places like Medicare, Medicaid spending. At the end of the day, who really knows? We'll see what happens. But we do have a major problem here in this country. And in my mind, not valuations, not the administration, but the biggest problem we have is the federal deficit. As I mentioned earlier, our federal debt is over 120% debt to GDP. That includes entitlements. If we look at federal net debt, not including entitlements, we're over 100% today. And it's expected to keep going. The red line is what the expectations are with the OBBBA bill that was recently passed. And if we look at the top chart, one of the things that we can see here is that we're heading towards a 7% annual deficit. And this is a big problem. As a government, as a country, it might be healthy to have a 3% deficit. We're heading towards 7. And the blue, the biggest portion of the deficit, is actually interest on our debt. Matter of fact, the actual deficit level is under 3. The interest on our debt is taking us all the way up to 7% of GDP. So this long-term is the biggest problem we face as a country, and we need to start making some hard decisions on it. If we go to the left, where are we spending our money? Well, if we look at total spending, the far left, $7 trillion. But Social Security, Medicare, Medicaid, and other mandatory expenses make up well over half of our spending. Well over half. Yet payroll deductions, which is generally what's supposed to be funding these benefits, only covers 25% of the spending. So we've got an issue. We're not pulling enough revenue to cover entitlements. Nobody wants to touch entitlements. And we need to start making some hard decisions here as a country, because this is not sustainable long term. And if we look at how we compare to other countries, the US debt to GDP, and this looks at, again, total debt, including entitlements, we're at 121%. We're in line with Italy, Greece, Japan, maybe not quite as bad as Japan. This is starting to get to be a scary thing, and that we as a country need to be dealing with. Yet, neither party seems to be dealing with it. Clinton was the last time we actually had a surplus. We actually made more money than we spent. But neither party is doing a good job. And it seems that every president that comes in spends more than the one before. Bush really got us into the 4% range. Obama, granted, came out of 2008 at a while, had deficits of 10%, but really ended again back at 4. Trump, so like everyone, it tends to be getting worse. Neither party can seem to reduce the deficit. Long term, this is going to be a big weight around our kids and our grandchildren, and we need to make some hard decisions here. Now, what the deficit isn't doing is it's not blowing up the markets. We're actually seeing foreign treasury holding go up. So people are still buying our bonds. People are still buying our equities. So things are not blowing up for us, and we normally don't see a massive just boom recession when you have really high debt to GDP. What you tend to see is slower economic growth. So maybe we'd be growing over 3% if we didn't have as high debt to GDP. Now, the Trump administration would argue that, yes, we had the OBBBA, but we're going to make up for that revenue plus more with tariffs. And we actually have seen some tariff increases from Trump's first term, and now that is starting to bring in more revenue. It's still very early to understand what that is going to end up being, but Trump's belief is that some of the tariff revenue is going to help close the deficit gap. Still too early to tell, but we are starting to get some significant tariff revenue numbers. Now, all of this fear of the debt to GDP, I think, is driving two areas of the market. Bitcoin and gold are both up over 20% year to date, while the S&P is 9%. Now, honestly, the other thing that's up over 20%? Internationals. So why are Bitcoin and gold, though, up so much? I think it's the fear of all the uncertainty that's going on. It's kind of this Vibecession. People are saying, you know what? The government policies, decisions, uncertainty. I know that Bitcoin and I know that gold are going to be there. Over the long run, though, I'm going to talk about gold first. Over the long run, On an inflation-adjusted basis, gold is not much higher today than it was in the 80s. So if we adjust for inflation, gold really hasn't made much money, if not slightly above inflation over the long term. Now, Bitcoin has done incredibly well. But the thing about Bitcoin is I have a hard understanding of the investment philosophy other than hype. To make money on Bitcoin, somebody else has to buy my Bitcoin at a higher price than I paid for it. If I invest in the stock market, every day I'm investing in businesses. And really, it's people. And people wake up every day trying to figure out how to make their life better. And to make their life better, they work, they create businesses, they start jobs, there's entrepreneurship. And what I'm investing in is owning a piece of the revenue, owning a piece of the earnings of those businesses that people are putting energy into every day to make their life better. And over the long term, those earnings, that revenue, that's a value. If we invest in the bond market, we're lending somebody some money and they pay us back with interest. It's hard for me to think about gold or Bitcoin as anything else other than speculation at best, where we're hoping we're able to buy it at a low price and sell it at a high price. But who really knows? Okay, let's dive down into some of the details. US stock market. Big concern today. Valuations are expensive. Matter of fact, we're getting back to valuation levels that we saw in 2021. The price to earning ratio on the S&P 500 is 22.2 times. The 30-year average is 17. So the market's expensive today. Now, we know it can get a lot more expensive. We saw 24 times, almost 25 times price to earning ratios at the end of the 90s leading into the big tech collapse. But the dilemma with high price to earning ratios is we need a lot of earnings growth to justify that price. Because here's the thing we know over the long term. When earnings are growing, over the long term, the market grows, right? But if we're not getting earnings growth to justify the price in the market, that's going to be a challenge. So what are earnings expectations looking like? This year, consensus analyst estimates believe we're going to get about 9% earnings growth, with most of that coming from margin improvement. My personal concern about margin improvement is, from what I'm reading, companies are eating the costs of tariffs and not raising their prices as much, which hurt margins. We'll see what actually happens. We've only gotten first quarter earnings, which were relatively good, but we haven't seen any earnings impacted by the tariffs yet. Now, consensus analysts also think we're going to get double-digit earnings growth for 26 and 27. We really need to be at these levels or better to justify the price in the market. One of the big uncertainties is, what if tariff negotiations don't work? What if, we get into a big tariff war? What if other countries start tariffing us on our exports? And you may think, well, the US doesn't export a lot of goods. True. But we export a lot of services. This can be digital services taxes. This can be other services taxes. But tech companies make over 50% of their revenue from foreign sales. Materials companies make over 50. Communication services makes over 40% of its revenue from foreign sales. So if we actually get into a trade war and other countries start tariffing us on services, effectively a sales tax, that could be quite challenging for US equities that really need high earnings growth to justify today's valuations. All of this environment is leading to Vanguard's 10-year market outlook. So am I saying we should not be investing in US equities today? No. But I think it's going to be very hard for US equities to perform as well over the next 10 years as they have in the last 10. Matter of fact, US equities, Vanguard expects US equities, think the S&P 500, to be up anywhere between 3.8 and 5.8% per year over the next decade. Why? Valuations are so expensive. And can we really get earnings growth to grow faster? Another way to think about it is we ended 2008 at a price to earnings ratio of 9 times. Today we're 22 times. So part of what has been phenomenal over the last 15 years is the higher multiple, higher price to earnings ratio on the S&P. You're not going to go from 22 to 40 over the next 15 years. That is not going to happen. So we're going to have a headwind of high multiples that we're going to have to deal with investing in the S&P 500. Internationals are cheap. Vanguard's expecting 5.4 to 7.4% returns annually over the next decade. If we think about value stocks, if we want to invest in the US, Vanguard's more excited about value, expecting 6.3 to 8.3, or small cap, expecting 5.3 to 7.3. So just because something has worked so well over the last decade, it's not unusual for it to be different over the next. Which brings me to internationals. As I mentioned, one of the areas that we find a lot of people are underweight in their portfolio, and Vanguard is really excited about. If we look at global GDP, only 27% of global GDP comes from the US. We're one of the economic superpowers, but not everything is US. Yet over 60% of global stocks are invested in the US. And the average US investor has 76% of their equities in US stocks and only 24% internationally. So overall, what we're tending to see is everyone's all in on US, particularly US investors. And there's been good reason for that. Over the last 15 years, the S&P 500 is up close to 15% per year. And internationals in other areas are up, some up high single digits, which you might think are great results. And I think are great results. But compared to 15 doesn't feel all that great. But let me tell you how our brains work. The way our brains work is we take recent history and we project it forward. So if we're going to say, 15 years, 15% per year in the S&P, I'm going to get that going forward. What if we don't? Internationals have lagged. US equities have been the place to be over the last 15 years. That same trend is going to go forward. What if it doesn't? And if we actually look at what we're seeing this year is US equities have had the weakest performance. Europe is up 20%. China's up 20%. Emerging markets are up almost 20%. Japan is up double digits. US equities are having great results, right? Almost 9%. But compared to these other areas, it's really lagging. Now, one of the tailwinds to international investing today, and you can see the purple, is currency. The weakening dollar is boosting up the results of international investing. But even without the currency, Europe would be up over 15% year to date, still handedly beating what we're getting out of the S&P 500. So if you're not globally diversified, and if you've been thinking, oh my gosh, why be an international over the last couple of years, here's a great reason to be making sure that you are investing internationally as well. And we're just excited about some of the long-term trends. If we think of the underlying fundamentals, the earnings growth we're seeing out of India, Japan are really exciting numbers. The earnings growth expectations we're seeing out of some of these countries going forward, especially if you consider the valuations are cheap, right? So we're having strong earnings growth and they're cheap and have room to grow. Whereas US valuations don't really have room to grow. It has to be pretty much all earnings growth, not multiple expansion from here on out. And lastly, here's a really interesting data point. The S&P from about fall of 2022 has been a one-stock winner. But if we actually look at Europe and Japan compared to the S&P without NVIDIA, they have handedly crushed the S&P going all the way back to October of 2022. So if you didn't own NVIDIA as part of your allocation in terms of US equities, if you didn't own the S&P, you were really left behind. So for a while, it's been a narrower and narrower and narrower market. The US market has still done well and is still doing well this year. We still think we should be investing in it, but there's a real possibility small cap, value stocks, internationals could outperform the S&P 500 over the next decade. This year, next year, who knows? Now, one of the other areas that we're excited about and that we've been offering to our clients and investing in for our clients this year is private equity, private real estate, and private credit. So why is this an area that's exciting for us? Well, the return potential is one of the reasons. If we look at private equity, it has averaged over 16% returns annually from 2016 through 2023. Past performance is no guarantee of the future. Private credit similarly is high single digit. If we compare that to US equities, we compare that to debt, these are just really exciting results. Matter of fact, if we dive down into one area, private equity, and we go with our same investment philosophy, we're big believers in being broadly diversified. And let's just look at big companies over 250 million in revenue. Big companies, 250 million. Only 14% of these large companies are publicly traded. You can actually buy them on a stock market. 86% of companies are private. And if we look at data from 1987 through 2023, private equity has averaged 14.8% per year. Public equity has averaged 10.8. The S&P has averaged 10.8. Private investing has worked out really, really well over the long term. Now, I think there's a couple of reasons for this. Looking at this chart here in the top left, it looks at publicly listed companies. There used to be about 8,000 publicly listed companies. Today, there's about half that. Companies are taking a lot longer to go public. Companies are staying private a lot longer. And it used to be you had to go public at some point to grow into scale, right? So as you got to a certain size, you couldn't keep raising money. You couldn't keep getting capital to grow into scale. Staying private, you had to go public. That was what you did. Now companies are staying private longer. There's a lot more private money sloshing around. For companies that are doing well, they're able to grow, and they don't have all the regulatory burden. They don't have the same quarterly earnings. Matter of fact, SpaceX, based on its most recent valuation, would be in and around the 35th largest company in the S&P 500 today if it were public, but it's entirely private. What we're seeing is if we do want to be globally diversified, and we do want to be size diversified between large size companies like the S&P 500 and small size companies, private equity, private credit, private real estate is something we want to be thinking about. And when we look at it from a portfolio perspective, just adding private markets to the portfolio tends to increase returns and reduce risk over the long term. Again, no guarantees of the future, but this is an exciting area. Bonds. Nobody seems to like bonds. I've been talking about this for a while, but they're not dead yet, I promise. Matter of fact, we're getting positive results for bonds this year. It's only about half the year, and bonds are up 4%. Where I think people are still frustrated is the bond market was down 13% in 2022 as interest rates rose so much. But bonds protect us when things are ugly, and bond expectations for the future are pretty good right now. The best predictor of bond returns is the current yield. Because if you think about it, you own a bond, it pays out a return, pays out interest, and then the bond matures, assuming no defaults or nothing else strange happens. Current yield on bonds is about 4.7%. That means the average annual return for the next 5 years is in the high fours. Those are pretty decent returns. So part of what the challenge has been is that in 2020s, when interest rates were close to zero, bonds got close to zero over that time period, with most of it being negative in 2022. Now, current yield is not a great predictor of next year's return, so you can have a lot of volatility in the bond market despite current yield. But what we're seeing is attractive yields today. Mid 4%, high yield bonds are 7%, leveraged loans are 8.5%. So bond market yields are attractive today. But the most important reason you own bonds in your portfolio is protecting you when things get ugly. So this is COVID. And we can see when COVID hit, the S&P fell, we were almost down 35, 40%. Bonds made money. Treasuries are up more. And the thing about investing is you got to think about time horizon. I have a client, and the client said, "Hey, Nick, I know I'm 65 years old, but I live entirely off my pension. I live entirely off that and Social Security. I don't need any more money. I want this money to be here, not for me, but for my daughters," right? One was a teacher, and I believe one was a nurse. And in his mind, he wanted that money to be for them. He wasn't going to touch it. So he said, "Hey, Mr. and Mrs. Client, well, it sounds like our time horizon isn't like the next 5 years because we're living off the money. It sounds like it's 20 years. I've got a great idea for an investment. And the thing about this investment is historically, and again, past performance, no guarantee. The thing about this investment is the worst return we've seen in any 20-year rolling time period for this investment. It's only made 8% per year. And that's the thing. Stocks have made, the S&P has made 8% per year is the worst return we've seen any 20-year time period. The best we've seen is 18, but the worst we've seen is 8. You need bonds to protect you if you're living off your portfolio, if you're going to be buying a house, if you can't sleep at night because there's some ugly drawdowns you need to live through to get those sort of returns. That's why you own bonds. If you don't need the money, if you're not living off the money, if you're not withdrawing your portfolio, if you can sleep at night, be a long-term owner of businesses. Here's the great financial crisis. The S&P was down 50%. It can get scary. Bonds are up. Here's the tech bubble. The S&P had a slow grind down 44%. Tech was worse. The NASDAQ was close to down 80%. Bonds make money. This is the reason you own bonds. Now, if you're investing in bonds and after-tax accounts, non-retirement accounts, we really want us to be looking at municipal bonds. On the far left, you can see in the dark blue and the light blue, this is the tax equivalent yield on municipal bonds, significantly higher tax equivalent yields than treasuries. Because again, municipal bonds, the interest is tax-free. So think about it. If you're in the max tax bracket of 37%, you own a treasury, pays out 4.5%, you might get to keep 3% after taxes. But with municipal bonds, whatever it pays in interest is federally income tax free. So that's a big advantage. So I'd be remiss this year if I didn't address the elephant in the room, politics and markets. Can't seem to get away from it. And I've been hopping on client meetings recently. I hopped on one for a client that is a big fan of Trump, loves what he's doing. And the first thing he said when he hopped on the meeting is, "Oh my gosh, Trump is killing it. He's getting all these negotiations. He's winning here. He's winning there. The market's going to do great the rest of this year and into next year. How should we be investing more aggressively to take advantage of that?" Oh, we talked about it. Then immediately after that meeting, I went into another meeting. And this particular client is very far left leaning. And he said, "Oh my gosh, Nick, things are breaking down. All the judicial orders, all of these tariffs, we're going to have crazy high inflation. It's surprising me the market has held up as well as it is. I can't possibly see good things happening over the next 3 years. What do we do to protect ourselves?" Here's what's important to remember. However you identify, however you feel about things, our viewpoint of economic conditions changes based on our political affiliation. If we lean Republican, we feel great when there's a Republican in office, especially when they're doing things. If we lean Democrat, we feel great when there's a Democrat in office, especially when they're having an impact, doing things. But the market doesn't care about politics. It's not red, it's not blue, it's green. In businesses, people don't care about politics. Every person that's running a business, every person that's going to work every day wakes up and doesn't say, "I'm not going to work hard this year because my favored political party is in office," or doesn't say they're going to work harder. They try to look at the situation on the ground and make the best decisions for their business, for themselves each and every day. And that's what drives our economy. So where do we go forward from here? I think it's important to not get emotional about investing. And I'm seeing a lot of emotion, either getting too aggressive or too conservative. And our job is to help bring that in to make wise decisions. And the thing is, our brains work. We take recent data and we project it going forward. If we look in the 2010s, 2011s, 2012s, real estate investing, the light blue, was killing it. The real estate was the best returning asset class. You know what my clients were asking me? Should we be investing more in real estate? Well, more recently, large cap US equities have been the best performing asset class. And people are saying, should I dump more in the S&P 500? We're big believers in being broadly diversified because something can run for a while and then not work. Matter of fact, if we look at the S&P, it is normal. Look at this. We had a flat time period, right, leading up to World War I, then the Roaring '20s, and then growth. Then we had a flat time period in World War II, then post-war growth. Then we had stagflation in the Vietnam War, no returns on the market for a decade, then massive growth, leading to the tech bubble. Then after the tech bubble, we had a decade of no returns. Now, let me tell you, when I started in this industry, you know what people said? Why are we investing in the S&P 500? The S&P 500 has gone nowhere for a decade. We had the tech bubble, we had 2008. Like, should we be investing? And now we've had these crazy, amazing 15% average annual results in the S&P 500 over the last 15 years. And people are saying, there's nowhere else I want to invest in. We should put it all in the S&P 500. Careful about overreacting to recent data. Things can change. And we're all emotional. We are. If we look at data from 2002 to 2021, the S&P's up 9.5. Emerging markets actually did better. Real estate actually did better. 60-40 portfolio, 7.5, 40-60 portfolio, 6.5, bonds, 4.3, inflation, 2.2. The average investor got only 3.5, barely beating inflation. And let me tell you, they made an emotional decision, whether it's once every 3 years or 4 years or 5 years, or they reacted to politics, or they did something. Maybe they sat on cash because they're worried about investing it. If you want to get market-like results, you got to take the emotions out of it. And we're all susceptible to it, particularly when it's our money. I tend to see people get a little bit more emotional once they've retired. They're no longer working because now this is all they've got and they're now living off of it. It's really important if you want to get market-like results, we have to take the emotions out of our decision-making process, and we're all emotional human beings. That's just life. So what does this mean for you? At Willis Johnson Associates, if you haven't met with us, if you're not a client, we do offer a complimentary first meeting. We'll review company benefits, compensation. We work with a lot of oil and gas executives and professionals. We have CPAs on staff. We do tax planning, preparation, and we can help optimize your tax situation so you save money and pay less in taxes. As I mentioned, I'm going to be doing a webinar on the One Big Beautiful Bill Act and planning considerations. And there's a lot of phase outs and there's a lot of opportunity to save taxes by taking advantage of this new rule the right way. That will be coming late August. And of course, we'll review your investment portfolio and recommendations. We're an award-winning firm. We like helping educate people on what we understand about planning, benefits, taxes, the stock market, so you can make the best decisions for you and your family. And we've designed our firm to be on the same side of the table as our clients. Here at Willis Johnson Associates, there are no product sales, no hidden fees, no commissions, simply great advice with your best interest in mind. If you have questions, include them in the follow-up survey at the end of the webinar. We'll get you a detailed answer. Thank you very much for spending time with us today.